In this video, continuing our discussion of AUC Section 315, gaining an understanding of the entity and assessing the risk of material misstatement. So up until this point, we have gained an understanding of the entity and including its internal control. In the past several videos, we went through gaining an understanding of their internal controls and the components of internal control. And now we are finally to the part of using all of that information to assess the risk of material misstatement. And so to provide a basis for designing and performing further audit procedures, when they say further audit procedures, that means procedures beyond doing all these planning procedures that we've done so far. So to design further audit procedures, we should identify and assess the risk of material misstatement. So the thought is that we should have an understanding of the organization and its internal controls and determine where it's likely that the financial statements are misstated or materially misstated. And then we can design certain procedures to reduce our risk of that being the case. So there are two different levels that they define in the standards here. There's the financial statement level and there's the relevant assertion level. So the financial statement level risks would be those that are pervasive across the entire financial statements. So examples of that might be fraud, for instance. If there's a risk of fraud within the organization, then certainly all of the accounts have a potential to be misstated. Override of controls, for instance. Maybe if they haven't complied with certain laws, that could jeopardize the entire financial statements and company as a whole. So anything that is a risk to the financial statements as a whole would be at the financial statement level. Next, we have the relevant assertion level for classes of transactions, account balances, and disclosures. And we'll gain more of an understanding of this later, but this would be more granular inside the different classes of transactions. So for instance, payroll and within the assertions in those payrolls. So for instance, that the payroll is accurate or that the employees and their paychecks exist, that the obligation of the organization to pay their employees is correct. And so those would be relevant assertion level risks. That gives us kind of an overview. What we're going to do is in this video, we'll talk about the financial statement level risks. And then in the next video, we'll talk about the relevant assertion level risks. So let's go down to the explanatory material at section A126 through A129 to get a little more color on how to identify and assess the risk of material misstatement at the financial statement level. Okay, so now we're down to the explanatory material about assessing the risk of material misstatement at the financial statement level. And so as we briefly discussed before, the risk of material misstatement at the financial statement level refers to risks that relate pervasively to the financial statements as a whole and potentially affect many or all assertions. So they're not really risks that are identifiable with a specific assertion at the class of transactions disclosure level, but rather they represent circumstances that might increase the risks at this assertion level. So as an example that we said before, the management override of internal control. So if there's a risk that management can override controls to make the financial statements say whatever they want them to say, then that's certainly a risk that is pervasive across all assertions. So they can do that to any account in the financial statements. So, and as we mentioned before, if there's any kind of fraud, that could be pervasive across the entire financial statements as well, depending on how the fraud is being perpetrated. And so they got some good examples here. So in most cases, the risk of material misstatement level at the financial statement level will most likely derive from a deficient control environment, or it could be due to declining economic conditions. So if there's a lack of management competence or a lack of oversight over the finances or the accounting of the organization, certainly that could be pervasive across the entire financial statements. And so we might have a financial statement level risk there that management's not very competent. So it's likely that all of the accounts potentially are misstated. And so we would need to respond to that risk in some way. Also, we might find if management doesn't have high integrity, then that might have us conclude that the risk of management misrepresentation in the financial statements might be too high of a risk for. Also, if the condition and reliability of the entity's records cause us to conclude that it's unlikely that we can get sufficient appropriate audit evidence, then that might be a financial statement level risk as well that's pervasive across all of the assertions. So in these cases, certainly if we decide that the financial statement level risk is too high, for instance, in the instance of fraud maybe, or management override controls, or management's integrity, or the reliability of information, we might need to withdraw from the engagement or take certain measures that are explained in AUC section 705. And that would be certainly if we're unable to design procedures that reduce these risks to an appropriate level.